Good morning, everybody. It's January 26th, Monday, January 26th, and it's been quite a year so far. Lots of roller coaster moves in the stock market, and geopolitics, and domestic politics, and the weather. We had three minor snowstorms until this one, and the one we got yesterday was much heavier. We had about a foot and a half of snow. Rest of the country got pelted as well. I hope you're all keeping safe and warm, and don't do your own shoveling. Get somebody that is fit and can do it. Don't want anybody hurting themselves. But if you're fit and you can do it, you have my blessing. Speaking of blessings, this has been a market where there have been some blessings, particularly if you've been overweighting precious metals, defense stocks, and generally speaking, the market's done all right. The small cap stocks, the S&P 600, S&P 400 have done very well. The large caps have sort of lagged behind. The Magnificent Seven has been kind of so-so this far. Let's see what the earnings stories are that they will report this week. I suppose they're going to once again be pretty good. The only question is whether they'll be good enough, and what kind of indications we get on the impact of their enormous capital spending on their earnings, on their cash flow, and so on. As you know, we've taken the position that until the second half of last year, the Magnificent Seven were kind of like the seven kingdoms in the Game of Thrones, and they're all pretty content to be isolated from one another, not have much to do with each other, kind of monopolize their own strengths in advertising or search or chips or iPhones and so on. But then AI kind of turned everything upside down, and suddenly these companies had to spend a huge amount of money on capital spending, on high-priced personnel to develop large language models, with a lot of uncertainty about where this is all going to go. Michael Burry got this whole issue going back in late October when he tweeted that all these issues that he raised, and the market's kind of been holding back on the Magnificent Seven as a result of some of the concerns, legitimate concerns, that he in fact raised. Meanwhile, the geopolitical situation continues to be unsettled and unsettling. We've got a armada of American naval operation heading towards Iran. I guess things are going to be somewhat quieter in Venezuela right now. Meanwhile, the Greenland issue seems to have a framework and seems to have come up with some decision here that the U.S. will have more military facilities in Greenland, and that those facilities will be on sovereign territory, U.S. sovereign territory. And I guess there's still plenty of other issues to be worked out with regards to mineral rights and all that. And oh, by the way, the locals want to maintain the sovereignty, and I don't think they're getting much of a vote in any of this. But we'll see how that plays out. Meanwhile, things are happening in China here before they go into their Lunar New Year. This is the year of the horse, but there's been some rather remarkable changes going on there with Xi purging his top generals. I think 4 out of 5 generals have been purged. One of them was accused of selling China's nuclear secrets to the United States. So it's whatever is happening there is unsettling as well, and you can't really call whether where it's going to go. Uh, I guess maybe this postpones any decisions by China on doing something about Taiwan. I think they need generals to run their military. Of course, their military hasn't had any really real world experience in actually fighting in any regards. So we'll see how that goes. But clearly, there's an increasing uncertainty with regards to how Trump's uh, revival of the Monroe Doctrine, the idea that the U.S. run things on the Western hemisphere, how that will change the minds, make them more aggressive or less aggressive with regards to Putin and with regards to Z. Meanwhile, it sure looks like that defense spending is going to go higher. The Chinese have been spending a lot of money on defense, and defense needs a lot of metals and rare earth minerals and things like that. In addition, here in the United States, President Trump is now calling for an increase, 50% increase in the defense budget from about $1 trillion this year to $1.5 trillion next year. He says that the tariffs will pay for that, and will pay to will be enough to pay off some of the debt, and send some checks out to people. I mean, that just doesn't add up at all. Um, but he clearly is going to be pushing for more defense spending. So all in all, I know, of course, we know the Europeans are already engaged in expanding their military uh, deployments and well, let's say military armory. They're increasing their production in that area. So the one thing that I think we can anticipate is that 2026 will continue to be a year of geopolitical uncertainties, unsettled and unsettling developments. Some of this has to do with the way Trump engages in foreign policy. He has a rather unique style of negotiating. He walks into a room with whoever he's negotiating and basically tells them, I don't even know why I'm wasting my time talking to you. I'm not happy with what you're doing. We are much more powerful than you are. How are you going to make me happy? So he takes an extreme position. And some people call it taco. Trump always chickens out, but I'm not sure that's an accurate description of what he's actually doing. I think it's kind of. I guess you really have to understand New York City real estate and how that all works. I think I mentioned this before. When you have negotiations in New York real estate, the developers there, the contractors are there, the labor unions are there, the public officials, zoning people are all there, and they're all screaming at each other. And if one of the participants is Donald Trump, he's screaming the loudest and bullying the most. And then all of a sudden, everything calms down, and they reach an agreement. They walk out of the room, arm in arm, hugging each other about what a wonderful deal they've worked out. And that's the way Trump negotiates. It's kind of loud and noisy and full of bullying, but that's his style. So I don't know that Taco really explains that. I think there's also a tendency now to the new kind of mantra is that there's a selling America trade going on, and I guess you could describe it that in some ways is true, but except for the facts. The data that we have from the Treasury Department shows that actually foreigners over the past 12 months, I think through about November, bought a record $700 billion of U.S. equities. That doesn't sound like they're leaving the U.S. Unless they suddenly started to do it. But I think this sell America trade idea has been it's kind of percolating for a while, and now it's kind of making the rounds. What else do we know? We know that when you look at the Treasury data, that foreigners bought something like $900 billion of U.S. fixed income securities over that 12-month period. So there's no evidence whatsoever that foreigners are dumping securities. Maybe anecdotally, some Danish pension funds are cutting back on their ownership of U.S. Treasuries. Maybe some of the data on central banks suggests that they are buying fewer dollars and buying more gold. So there's clearly some to that. But the sell America trade idea is, how else to explain why gold and silver are going straight up? And I think the explanation is geopolitical. It's geopolitical risk on. And why don't we have a look at some charts that I put together for the quick takes? Let's see. I just wanted to see if anybody was on the Q&A, and you are, so I'm glad I'm broadcasting. So where do we want to go? Just forgot. There we go. Share screen. Let's look at this. Okay, rock and roll. So this is the quick takes, and this was we put this out just on Sunday morning. Had nothing else better to do with the snow. Usually we go out for a bit of a brunch, but instead we stayed home, obviously. The brunch place closed, everybody closed. But here we go. So here's a chart that we've shown you before. For a while there, we were mostly focusing on gold, and we noted that if you look at gold, it broke out above $2,000 an ounce back here in 2024. When it did that, it was the first time I ever expressed an opinion on gold. I never had an opinion on gold before because I just don't have any model, don't have anything to discount in terms of cash flow to value gold. But when it went above 2000, I said, hey, this is really pretty simple. Russia invaded Ukraine back in 2022. The Europeans and Americans froze the assets of the Russians. Central bankers in countries that don't get along with the West decided they better own more gold and fewer dollars and euros. And so I said, I'm bullish on gold. End of story. And then it got to 3,000 at the early last year. And I said, okay, I think I can now technically look at it. And technically, it looks to me as though it's going to go to 4,000. I'm an amateur technician, by the way, very amateur. But it's work. Amateur sometimes works, simple sometimes work. And I said, 4,000 by the end of 2025. And we got to 40, when we got to 4,500, I said, all right, I think I better raise my target for 2026 from 5,000 to 6,000. And here we are already at 5,000. So I'm wondering whether I should be raising my 6,000 target. But I'm not going to overdo it here. I'm going to stay with 6,000 by the end of the year. And I still got that 10,000 target by the end of 2029. So if it gets there a little ahead of schedule, I could always say, well, got there ahead of schedule. Meanwhile, you got platinum going, suddenly decided that it wants to join the party. Silver, I looked at also back when gold broke out above 2000. I said, silver also looks like a breakout situation, but I really focused on gold. But silver has obviously been the big story because it's a precious metal. It's an industrial metal, and it's a byproduct metal in mining. So it's the supply is somewhat constrained. But at any rate, it's gone straight up to $100 today, and gold is roughly at $5,000 today. When we're doing more and more work in our charts, instead of doing indexes, we're actually showing ETFs because at the end of the day, we all want to make money in these markets. And so this shows you the ETFs on the same ratio scale for the Invesco precious metals. So that is the blue. Then there's the rare earths. So this has got gold and silver and platinum and palladium in it. This has the rare earths, and this is the Invesco base metals fund, and you can see that hasn't gone straight up, but it's looking as though it's getting set there. And obviously, that's being driven up by copper. Tin has really taken a fly to the upside. Lead is kind of still got lead in it, so it hasn't gone straight up. But increasingly, it looks as though there's more going on than just precious metals. And again, I think a lot of that has to do with defense. If defense spending is going up, defense requires a lot of different kinds of metals, including precious and rare earth minerals. The other thing that's going up, of course, is AI infrastructure, and that too requires a lot of precious metals and rare earth metals. So here's a fun chart of the CRB Raw Industrials Metal Spot Price Index. Um, believe it or not, this was not included in our database. So somebody bought this data. I should have gone into the business of buying data because this was publicly available information from the CRB Commodity Research Bureau, and then they got bought up. And anyways, the CRB indexes were bought up and now cost 10 grand just for the three that we use. But I love these indexes. They've got a long history and they've really been good. And so this one includes copper scrap, lead scrap, steel scrap, tin, and zinc. And obviously, the people who are managing the DB Base Metals fund are doing a good job of following the prices of these. And so here again, you got this thing moving higher. These are commodities, so you would expect at some point supply would increase to meet demand. But right now, we're sort of in the Looney Tune phase, I guess, of this move in metals. Here's what we have year to date in terms of various commodities. Lithium is a big winner. Tin, as I mentioned, is up a lot. Silver and precious metals is the winner. Platinum, palladium, gold is actually a laggard in this case. So at the top of the leaderboard are the metals. So here's another fun chart: CRB Raw Industrials Metals again, spot price versus emerging markets ETF. I think I got that wrong. I'm going to have to fix this. I'm pretty sure this is the CRB Raw Industrials Spot Price Index, which, yeah, I'm going to have to review that. But it's pretty much the same story. Let me have a look here. Yeah, this looks like the CRB Raw Industrials. So it's being led up by the basic metals. But here you can see the correlation is pretty damn good. This is the CRB Raw Industrials. See, it does say CRB Raw Industrial, so that's what it should be. So this is versus the emerging markets ETF, and this is the EEM. So that's the one we're following as a way to kind of overweight emerging markets rather than try to become experts in each individual country. And I think that the message from this chart is that when you invest in emerging markets, you're basically investing in commodities. So if you're already got a big commodity position with S&P 500 energy or S&P 500 materials, and then you take a big position in emerging markets, be aware of the tight correlation between emerging markets and commodity prices. This is another chart of ETFs. This one shows you the EEM, the emerging markets, going all the way back to 2004. And notice it's been kind of a great trading vehicle, but not an investment vehicle really at all. It's been kind of flat here. And so this has been consistent with our view to stay home rather than go global, especially with emerging markets, which kind of yin-yang you all over the place here. But recently, at the end of last year, we said, okay, let's go overweight emerging markets. And it's not that hard to do. In an MSCI global portfolio, they're only about, 10 to 15% of that portfolio. But we suggested the EMXC, which is the emerging markets excluding China, because we're just not big fans of China for all kinds of reasons we've discussed before. And, it doesn't look like we're losing anything by not owning China. This is a bar chart of the performance year to date of the various emerging markets. So South Korea and Taiwan is here somewhere, are basically plays on semiconductors. So that's the technology play. It's also a geopolitical play. I mean, defense needs a lot of semiconductors, but defense also needs a lot of commodities. So um, I don't. Maybe this is Brazil is more soybeans than any particular commodity, but Chile is definitely copper. Not sure what's going on there. Mexico's got a silver component to it. Um, but again, we're a small little operation. We're not going to pretend we can give you guidance on specific countries. Though William Pesek, we hired him about a year ago, is doing an outstanding job of covering some of the countries that are here, like China. Uh, Japan is not an emerging economy, but was done work on that. India's not doing so well. It's still a laggard. So here's aerospace and defense. So let's keep track of this ITA. I'm sure you're all familiar with it. And these are some of the other ETFs that are in the defense sector. So if you are interested in a transatlantic defense, NATO, there's a NATO ETF, and then there's a European ETF for European aerospace and defense. That's actually the purple one here, which has had a pretty good move. So here's just showing these last two charts. This is defense and this is semiconductors, and they clearly are creating this enormous demand for metals. So I guess with the benefit of hindsight, in addition to overweighting financials, industrials, healthcare, and market weighting now technology and communications, we would overweight materials, and that's easy to do because that's really tiny, 3 to 4%. Um, I don't know. I don't really. I want to spend a little bit of time with questions, though. I only have one so far. So, if any of you want to throw in some questions, feel free to do so. But the morning briefing, we discussed the profits in praise of record profits, and the basic message is the economy's been resilient. So guess what? Profits have been resilient, and because profits have been resilient, the stock market's doing extremely well. And before we get there and talk about all the happy stuff, well, this is a happy thing. This is real consumption per worker is at an all-time record high. We've discussed the recent flattening of disposable real incomes as probably related to baby boomers retiring and spending money that they've saved. So consumer spending, we think, is going to remain resilient. The economy still looks fine to us. The real wages for production and non-supervisory workers, all-time record high. So, profits are supposed to, according to David Ricardo, profits are the kind of the key essential element to the happiness of a country. And so the question is, why aren't we happier? And I guess the answer is that, when you look at real consumption per household, that's on average. And there are people who are below average that aren't doing too well. And there are people in the real average hourly earnings that are above that, but they too, there's also people who aren't doing as well. I think, as I've said before, a lot of it is related to demography. The baby boomers are doing really well, and younger generations are not. But I think the baby boomers are providing some assistance to the younger generations, and the baby boomers are going to leave a lot of big inheritances on balance to the younger generations. But let's go to the happy story here. Resilient economy, resilient profits, pre-tax all-time record high, profits after tax all-time record high. This is from current production, so it's adjusted for depreciation and inventory gains, so it's sort of cash flow profits. Um, and you can see that corporate profits from the rest of the world, receipts are all-time record high, which also speaks to the resilience of the global economy in the face of Trump's tariffs and all the, Russia invading Ukraine and all that. And yet our receipts from overseas, all-time record high in terms of profits. The strength in profits here has meant that dividends are at a record high. They're kind of flattening out a little bit, but they're at a record high of $2.3 trillion. The undistributed profits are also at a record high of $1.2 trillion dollars. So a beautiful picture brings tears to my eyes to look at something so beautiful. And here's more beauty here. This is corporate cash flow, uh, all-time record high. And the big tax shelters tax reported depreciation, that's huge, $2.8 trillion dollars. And then add that to the undistributed profits, and you get record corporate cash flow. Um, just wanted to see something here. Yeah, okay. Yeah, just looking to see the audience today. Again, we got a really good audience. I appreciate that. What are we were looking at? Oh, capital spending, I think. Non-residential private fixed investment, all-time record high, $4.3 trillion dollars. That's what we're looking at here in the red line. And so that's easily covered by, it's not, well, corporate profits are down here, but I'm also raising the notion that proprietors' income, which is people like me, we do some capital spending, and there's 30 million of us. I'll show you that in a minute. Meanwhile, here's another chart: non-residential private fixed investment, as we just saw, 4.3 trillion, corporate cash flow. So there's corporate cash flow and profits are driving capital spending. Capital spending, in turn, is paying off in productivity. The 3-year annualized productivity growth rate is up to 2.5%, above its average of 2.1. And in the roaring 2020 scenario, it's going to go to 3 to 4% over the rest of the decade. This also shows a good correlation between productivity growth on a 3-year annualized basis and real hourly compensation. Workers do benefit from productivity growth, so we're expecting that will be a big positive. Profit margin is another winner from productivity. This is the profit margin based on GDP. Hasn't really gone anywhere, around 11%, but it looks like based on what the S&P profit margin is doing, that it's going to go to a record high over the next couple of years. And you can see that in the that we are going to make a record high in the S&P 500 profit margin based on the forward weekly profit margin story. So here I am, one of the sole proprietorships in this chart. There's 30 million of us. And so everybody kind of tends to focus on corporations, but there's a lot of little shops like ours that hire people, that pay taxes, that try to grow, and we obviously do some capital spending. Figure 14, personal income. This is proprietors' income. I mean, it's a nice big slug of change, $2.1 trillion dollars. So we're basically at a record high in proprietors' income. Rental income is not a business. Well, this is rental income in personal income. So it's what mom and pop who decided to invest in some real estate, fix it up, and rent it out. They're getting some income that way, and that's also sizable at 1.1 trillion. Very diversified economy with a lot of people trying to do better. Business applications over the past 12 months, all-time record high of 5.6 million. So explain to me, please, why payroll employment's up only 700,000, down from 1.8 last year, down from 1.8 million before that. Something's just wacky here. So usually in the past, profitable companies would expand by hiring more people, by expanding capacity. Now they seem to be expanding capacity, spending more on capital, but recently not so much on labor. So this is payroll employment versus after-tax corporate profits. So maybe it has to do with the fact that the capital that people are spending on increasingly is technology, and that has increasing uses in augmenting productivity. So it's reducing the need for labor. But initial unemployment claims, I'm getting a gut feel here that the labor market's going to surprise us to the upside, with initial claims dropping the way they have been, and with continuing claims dropping recently. So let's see whether my gut instincts work or not. I guess we'll do that next week. So I got 1 minute if we stick to half an hour, but if some of you are willing to hang around, I'll cover as many questions as I can here. And yeah, stop the clock. I don't have a time to answer more questions than I got. But Patrick, if the Supreme Court rules against the Trump tariff policy, how do you think the markets will be impacted, and how do you think the markets will react? Good question. I'm getting a little bit queasy about the bond vigilantes. I mean, they haven't been doing anything here. It's been really quiet. And on January 7th, Trump said that this is when he, on Truth Social, said that he wants to increase defense spending by 50% from 1 trillion to 1.5 trillion. And the bond market doesn't seem to react at all. Maybe it's too soon to for them to get concerned about that. But he claims that tariffs are going to help pay for that increase and pay for some other things like paying down the debt. He said that in Truth Social. He should have this looked over by an economist. He should call my friend Eric Wallerstein over at the Fed and have him double check some of these things. But there's just no way in hell that a $500 billion increase in defense spending is going to be covered by tariffs and send out $2,000 checks and so on. But to your question, if the Supreme Court rules that the tariffs are illegal, then I guess as a practical matter, the Treasury may have to refund money, and suddenly instead of having the 400 billion in tariff revenues they were counting on, they won't have that. Or else maybe they will cleverly come up with other ways to justify the tariffs, and the revenues will still come in. But anyway, you look at it, it's not going to reduce the deficit. It's not going to reduce the debt. Even if it just self-finances itself, we're still looking at $1.5 trillion. If it doesn't self-finance itself, we're talking about two trillion dollars. So I think the bond market. I'm watching the bond market. I think at some point here we may get more of a reaction to this laissez-faire attitude towards the deficit. Don't worry about it. Maybe the bond vigilantes have been kind of working overtime in Japan. But even there, with the big surge in bonds, William is writing a piece for tomorrow explaining why Japan seems to be impervious to what's going on in the credit markets. Maybe it's because they owe the money to themselves. But we'll discuss that. Jeffrey, can you speak to the historical volatility of silver versus gold, and if now is an okay entry point? I don't. I mean. I wouldn't say now is a good entry point. There was an entry point a year ago that's quite good. And we pointed out it on gold and kind of technically showed it on silver. But silver can be extremely volatile. And we saw that with the Hunt silver crisis. This looks like actually potential for more volatility than what we saw back then. So I'll leave it to you. I don't do trading very well. Peter, please address valuation, especially as it relates to your macro overview. Quick one on valuation. We've talked about it before. I don't really have a problem with a 22 forward PE as long as I'm right about the roaring 2020s, as long as I'm right that we're not going to have a recession between now and the end of the decade. If we have a recession scare, then the 22 multiple could go down to, I don't know, 15, 18. So we could have a pretty significant correction. If we have a recession, we'll go down to below 15 and we'll have a bear market. But the economy has demonstrated its resilience. Earnings have demonstrated their resilience since the beginning of the roaring 2020s. And so it shall be for the rest of the decade. And again, I'm not telling you there's no risks here. I've said that's a 60% probability scenario. 20% melt up in the stock market. Now I think I have to add 20% melt up to the stock market and or precious metals. We'll see how far that goes. I mean, like I said, it's been a melt up in metals. I only wanted the gold to get up to 4,000 by the end of last year. I only wanted to get to 5,000 by the end of this year, and I've had to raise my targets. Peter, the likelihood that U.S. GDP forecast for 2026 could be too high. No, well, it depends whose forecast, but if my forecast is high, I think we're going to get 3.5% growth. and that's based on productivity. So 60% that I'm right, and maybe 20% that I'm wrong. Michael, backing out imports Q3 growth was 2%. That used to be called stall speed, not a concern. Not a concern if you look at the other components. I mean, consumer spending was strong. Capital spending was strong. So no, I don't really have a problem with that. William, GDP now hit 5.4% today, excluding COVID. This is the fastest since the 1980s, leading all major economies. If this continues, it's difficult to digest. What will greater than 5% growth due to the federal debt situation? Well, that's what the administration's counting on. They're saying, please be patient. We're going to get amazing growth out of all this, and so the debt to GDP ratio will come down because GDP will be better, and because better GDP means better tax revenues. So there is something to be said that. I mean, we could potentially grow ourselves out of the problem, but the problem is with the politicians like to continue to spend. So that's where we are. Take one more question here. Lee, it is possible that laid off workers due to AI and corporate downsizing are creating new consulting and advisory services to fulfill some of the rules. Yeah, absolutely, Lee. And I mentioned this when I went, after I met with clients in Boston, a Harvard professor who was a client, a client of ours, told me that her 100 students in her finance class are all depressed that companies aren't jumping all over Harvard students to hire them. And she anticipates that 25% of them are going to go straight and start their own businesses. So I think there's something to be said for that. All righty, folks. Thanks very much. Keep your seatbelts on. The roller coaster ride is it can be fun. It can also be kind of scary, but I'll try to help you with the fun stuff and try to help you deal with the scary parts. Thanks very much. All the best.